Depending on the location, purchase price, or value of a property, most lenders will apply a sliding scale that reduces the amount of money they will lend on a transaction. Lenders have different sliding scale policies surrounding the purchase price or property value threshold that triggers a sliding scale and the percentage above the threshold they will finance. For example, a lender might fund an 80% loan to value mortgage on a $1.1 million purchase, but not on a $2.5 million purchase. Instead, they might lend 80% on the first $2 million and 50% on the $500,000 balance, resulting in a total mortgage of $1.85 million, a 74% loan to value. The purpose of a sliding scale is to limit the amount of capital that lenders provide on higher valued real estate, a relatively less marketable segment, to mitigate risk and loss in a market downturn. Although this affects a relatively small market segment, it can materially impact the equity an existing homeowner can access and require a purchaser to provide a larger down payment.